From tax changes targeting high-income earners to an increase to the withdrawal limit for the Registered Education Savings Plan, there are a number of items in the latest federal budget that could impact your personal finances. Nicole Ewing, Director of Tax and Estate Planning at TD Wealth, joins me now to dig into some of the measures you're going to want to have on your radar. Nicole, great to have you with us as always.
Great to be here, Greg.
Okay, we got some very interesting items here. I want to start with this one. This is the high-income earners, something called the alternative minimum tax regime, and some proposed changes here. What's happening?
Okay, so just to level set, the alternative minimum tax has been on the books for a very long time, and it requires people to run a separate calculation alongside their tax return that they're claiming, and remove certain amounts. So high income earners often do things like maybe access the capital gains, lifetime capital gains exemption, or do charitable deductions. And that brings the income down to a level that the government says you have used too many of these tax strategies, you have used too many credits and deductions to lower the amount that you need to pay. We are going to have a minimum tax that you need to pay, and that's 15%, and the threshold is $40,000. So that has been on the books for a very long time. What we're seeing now is a real narrowing of this to direct high-income earners. So we're now going from a 40% threshold to the beginning of the fourth federal tax bracket, so we're about $173,000, and we're going from 15% to the 20.5%. Essentially, we are broadening the base. We are including things that wouldn't have otherwise been included. We're including the capital gains from 80% to 100%. And so we are including things from the donation credits up to 30% of the donation of prescribed the shares of public corporations. So there's interesting changes to what's going to be included when we're thinking about the alternative minimum tax, and it's probably going to hit a fewer number of people, but much more significantly.
Okay, so very interesting there for any high-income earners, and put that on their radar. For Canadians that own a business, I understand the budget's also proposing some changes in the way they could transfer that business. Walk me through that.
Okay, so this is the saga of Bill C-208 that we have been dealing with for a number of years. And essentially there was legislation passed with the intention of leveling the playing field so that children of a business owner had the same tax treatment as a stranger did. But when this rule was put into place a couple of years ago, when this legislation was changed, it left the door open for some planning that the government has said is not a genuine intergenerational business transfer. And so these rules have gone through a couple of modifications. And what we saw in the budget is essentially a closing of what some might consider loopholes to ensure that we only have the genuine transfer. We have put limits on the type of we have the two types. We have the immediate and the gradual transition, and there's different rules with different time frames that will now apply. Essentially, these rules are about how long you're able to maintain control as the parent vendor. At the immediate, you've got to give up that control right away, whereas with the gradual, you have a little bit more time to still continue to influence the business. There's rules about how long children need to be actively involved in the business. And so when we're looking at the different types of strategies, people are going to have to choose between the immediate option and the gradual transition. And there's pluses and minuses on both sides. I think probably what would be catching the mind of most people who are thinking, well, I'd like to take advantage of the gradual method and have a little bit more time to do things. You are also then going to be restricted in how long and the amount of shares that you're able to retain and shareholder loans that you're able to retain. So if you do the gradual method, you're going to limit, I'd say, some of the cash flow options that you may have thought that you would have when you typically do these sorts of estate freezes that this legislation is talking about.
This next one, Nicole, I found personally interesting. I have a son in university, another son graduated from high school, going in the fall. It is not cheap. So when it comes to the Registered Education Savings Plan, I understand some changes or proposed changes to the withdrawal limits.
This is, I think, a direct reaction to the increased costs of post-secondary education. So the RESP withdrawal limit of the education assistance payment, so that's the amount of government grants and income that has been earning tax-free within the RESP, you are limited to only being able to take out $5,000 that first 13 weeks of school. That's going to increase to $8,000. So there's no downside to that in terms of being able to pull that money out. And you may want to think as well about some of the strategies about pulling that money out earlier than later while your children are still in the lower tax bracket before they start earning some of their income during school and potentially having those amounts that are going to be taxed in the beneficiary's hands taxed at a higher amount.
Nicole, I'm going to squeeze in one more question quickly in a minute. The Registered Disability Savings Plan, there's something here. Break it down for me.
So the Registered Disability Savings Plan, the big issue here is that many of the people who have these plans actually, or who could benefit from these plans, don't have contractual capacity. They're not able to enter into a legal agreement. And so there had been rules that allowed for a family member to open these accounts and act on their behalf. That has been extended now for another 3 years, and siblings are now able to also act, not just parents and spouses. So that's really good news.
Always a pleasure to talk with you, Nicole, and to get your insights.
Thanks, Greg.
Nicole Ewing, Director of Tax and Estate Planning with TD Wealth. Well, that's our show for tonight. If you had any comments or questions, or if you'd like to get in touch with an advisor, email us at moneytalk@td.com. And make sure to check out our new show, Money Talk Live, airs weekdays at noon on TD's web broker platform. You get more time with your favorite guests, as well as some new ones who answer your questions that you send in. Thanks for watching. I'm Greg Bonnell, sitting in for Kim Parley. We'll see you next week.
The preceding paid commercial program was brought to you by TD Wealth.